Hi, it's Mike GRAZIANO. I am global co-head of the real estate investment banking business at Goldman Sachs, and I've been put in charge today of a very esteemed panel, folks that have been around for a long time, and that we can all learn from. A quick introduction, just going around the horn. Ron HAVNER, chairman of Public Storage. Ed ALDAG, chairman, president, CEO of Medical Properties Trust. Owen Thomas, CEO of Boston Properties, and last but not least, Mary Hogan, investor extraordinaire, and now a member of a number of public boards as well. So she'll bring a little bit of a different perspective than the others. Our topic today is the long-term impact of COVID. And so while we always want to be, I think, forward-looking, I think it would be helpful just to sort of start with one backward-looking question. It's been almost exactly a year or so that we've all been talking to each other through these boxes on the screen, and a lot's happened in that year. And I was wondering if maybe it wasn't a good way to start. Just go around the horn in no particular order. Maybe Ron will start with you, and if you could all just spend a minute or two talking about the impact of the pandemic on your business specifically in terms of its function, and then also its financial performance. As we all know, the situation has impacted a bunch of different property types in somewhat different ways. And so let's just start with that as a basis, and then we'll roll from there. Ron, why don't you kick us off, please?
Sure. Well, starting in March, we had a surge in demand as students had to leave colleges and universities. So our college properties and others filled up as the students went home. And that quickly changed into the second quarter as we saw a dramatic drop in demand and move-outs. So both move-outs and demand dropped in the second quarter. That started to pick up in the third quarter and has continued into the fourth quarter and the first quarter. While move-in volume is down 5-8%, move-out volume is down 8-10%, and customers are staying much longer.
And how did the financial performance, Public Storage over the last year on a maybe a nominal and relative basis in your view versus other properties?
Q1, no real impact. Q2, our revenues went backwards about 3.5-4%. Q3, they were down about 3%. By Q4, we were even, and well, Q1 will probably be positive. And then, of course, going into 2021, right? So the comps for Q2 should be great. The comps for Q3 should be pretty good because we had declines in 2020.
Okay. And how about, on the healthcare side and the hospital side, how did this, impact your business model?
So, Mike, that's an interesting question. Owning hospitals all over the world, we probably got hit the hardest first. Certainly not the hardest, but certainly first. In early March, first week of March, into the first week, beginning of the second week, I got a call early one morning about 7:30 Alabama time from 10 Downing Street. And I got a top secret phone call in which they told me that they'd given up on protecting their citizens, and they were going to assume that there were so many people with COVID, they needed to take over our hospitals. We're one of the largest owners of private hospitals in the UK. So that got my attention that COVID was going to be an absolutely real issue. We own 8 hospitals in Italy, so we saw the immediate effects there. So very, very, very quickly, governments all over the world shut all hospitals down. And I'm certainly not here to point fingers backwards in hindsight because none of us knew what we were dealing with, and everybody was doing the absolute best that they could. And we were trying to make sure that there were enough beds available for all the COVID patients that we thought we were going to have. So literally our hospitals all over the world were shut down for 3 months. The very interesting thing is that governments all over the world made sure that hospitals had plenty of cash flow, they had plenty of liquidity, and so they reimbursed the hospitals for those 3 months they were shut down waiting for the COVID patients. But on top of that, as we know here in the US and elsewhere, they also threw a tremendous amount of liquidity at hospitals, again, because they didn't know where this pandemic was going and how long it was going to last. None of our hospitals had to use any of the additional liquidity. They obviously all did use the grants from the 3 months that they were shut down. But if you look at excluding the grants, excluding any of the other advances, our hospitals still generated a more than a 2 times EBITDA coverage. So financially, that's truly a remarkable performance, being shut down for 3 months and still having a 2 times coverage. So we've never suffered from cash flow at Medical Properties Trust. We collected all of our rent in 2020 and ended up truly having a fantastic year. We acquired about $3.5 billion of properties, most of that before the pandemic and very late in 2020. But overall, it was a very good year for us.
Thanks. And Owen, I think your business is probably the most transparent and the most written about in terms of all this. But maybe a quick summary on your side as well.
Yeah, delighted to, Mike. By the way, I'm not in New York. I'm on my first business trip. I got vaccinated and immediately got on a plane and started getting out there. So it feels great. I hadn't used my Boston Properties credit card, I think, for a year. So anyway, delighted to be doing this. In terms of our business, as I'm sure everybody knows, the issue is people are working from home. And so many of our properties are much lower census. They've stayed occupied from a leasing standpoint, but they today, I would say, depending on the city, somewhere between 8 and 12% of the workers are coming back to the office. And it's been like that for over a year, probably lower. At early days in the pandemic, it was actually illegal in all of our cities for other than essential workers to go to the office. So people aren't using our product generally. That being said, we have been collecting about 99% of our office rents. So the impact economically on the company has actually been more in the variable income streams. So first quarter, as Ron mentioned, we were very much on track, but because of our variable income streams of parking, some of our retail, and we own one hotel, our run rate FFO per share went down about 15%. We maintained our dividend. We continue to maintain our dividend. Our stock's down more than that. And I think it's primarily because of work from home concerns, which I can talk about in the future. We became health security experts, which I can also talk about, as we get into more questions. We did a lot of restructuring of leases with our retail customers who were in need. So that being said, notwithstanding what I mentioned about the office, we have been able to do a lot of leasing. So we leased over 3 million square feet in 2020. That was about 60% of our market, 60% of quote normal. And the market leasing activity was about 40% of normal. So we felt good about that. And these aren't just short-term kick the can renewals. These were the weighted average lease term of all those deals was over 8 years, which we felt good about. And then lastly, we were going to launch a couple of speculative office developments that we put on pause as a result of the pandemic.
Hey, so Mary, you were an investor in this space for a long period of time. What is your assessment outside maybe a little bit looking in on, the investors in the public markets and kind of whether they got it right, how they reacted? Obviously, all the asset classes all had varying levels of performance based upon market judgments as to how this was all going to impact the business models, as we just did a quick run through. What's your grading in terms of how the public markets performed here?
I actually, despite how stressful it would have been, I really missed being actively in the market over the last 12 months because, historically when we have crises, you have maybe a couple of inflection points of just crazy performance that you can trade around. With this, we had 4 or 5, right? We had, whether it's, a stimulus, the initial shutdown, the stimulus announcement, the news of the vaccine, and then the next stimulus announcement. And as a portfolio manager, you could have lost your whole year in REIT specifically every time that happened because there was such a change from value to growth or whatever. And it's been super interesting over the past 12 months ago. I think that seeing REITs, drop so drastically, it was like the market was telling us, I don't know that leases are valid in this new environment, and that I can't think of much worse happening to our sector. And then we move past that, and people staying in the what seem to be safer, more growthy sectors. Everybody, all these great CEOs on this panel, focused on looking over the mountain to what's ahead. Investors have been pretty good about that, although maybe now it feels looking not very far ahead in terms of the sectors that are performing well.
When you're in that, the position, and I think everybody generally understands, in times where you have a lot of money flowing in, you turn around and the mailbox is full of cash again. And so you have to put it to work, and you go either deeper in certain positions or broader in terms of the number of companies that you invest in. And then, of course, the exact opposite, when you're dealing with a lot of redemptions, you have to make some decisions, presumably on where to sell. How does that work? I mean, what was your general, philosophy on that? And what do you think is the right philosophy when you have moments like we went through early on, and you have a bunch of money flowing out? Some folks have a view that, everybody kind of sells the most liquid stuff, whether that's the right thing to sell or not. It's a way to sort of effectuate your trade. And others, focus on the longer game and trying to move out of specific names. And maybe it's a combination of both. But how do you view that?
Yeah, unfortunately, in the short run, even if you are not decide that you are not going to, make a short-term move and sell the most distressed sectors, it doesn't matter, because that's what the market is doing, right? And so, what was amazing over the course of the year is to see just how the benchmark composition has shifted so dramatically, where now you have well over half of the benchmark is in non-core real estate sectors. So I would say, in the beginning, you just sell what everybody else is selling, but you have to be watching for a good opportunity to start accumulating in things that are the most beat up. And you have to, remind yourself that you can't worry about missing the first 10% or the last 10%. You just have to do it. And one other thing about all this volatility, I think, is, volatility has not been the REIT market's friend over the past several years. I think that people question whether REITs should be used as a proxy for real estate, and there was a real disconnect between real estate values and where the REITs are trading. And I would say that has really reversed itself nicely in 2020. I think that the volatility created so many asset value opportunities in the stocks that that disconnect seems to have pretty much righted itself, even though it took 3 years.
Yeah. Okay. Well, look, that's the stage for what kind of happened over the last year in the space, amongst all the everybody here. Maybe we go a little bit to the interim stage of changes, and then we'll talk a little about the future. So maybe again, Ron, starting with you once more around the horn, and then we'll mix it up a little bit. Given what we just went through, what would you say, the one or two specific changes that you made, that Public Storage made to its business model? And those changes, do you view them as temporary, meaning they were there for a reason and now we're back to normal, or are some of them permanent, or maybe more likely a combination, thereof?
Yeah, before the pandemic, we'd been experimenting with some greater technology in the operation of our business, and piloting a thing we call e-rental, where you can do all your leasing online. When the pandemic hit, that got rolled out right away. And so today, about 46% of our customers today do their leases online. They do not come into the office to do the lease, and they vacate online. We've also rolled out an app that enables them to do most of the business that they want with us, whether it's pay us, vacate, find their property location. A lot of them are using the app. We had 2 call centers, one in LA, one in Arizona. Those both went remote in April, and in fact, we're converting the call center in Arizona to self-storage. So the big call centers of 200 or 300 people together, gone. That's not coming back. And we've injected technology there to automate the calling process and the quality control, et cetera, with the call center. So I don't see that changing at all. This has had an impact on our labor because customers doing more online or on their phone. We don't need as much labor in the properties. And so that's started to happen in the third quarter. It's continuing in the fourth quarter. And I see that continuing into 21 and 22. The other thing that's interesting about the business is customers, Owen talked about 99% of paying. Our delinquencies went to virtually nothing. Okay, so big decline in our revenue was late fees. We make a fair amount of money on late fees, and people just went to auto pay, credit cards. And so we've had a big decline in late fees and a big increase in auto payments. I don't see that changing either, because I don't see a lot of people coming back going, oh, well, good, let me bring a check into you or some cash into you so I get to interact with the property man. No, it's automated. So we're doing other things like kiosk and a few other things that will continue to roll out. So I think the technology initiatives got accelerated and they will continue going forward.
Ed, how about in your business? Things that changed that you had to change to your model, and how much of that sticks versus is there now for the time being, for the foreseeable future?
So the biggest change is this, is that we all see each other this way. Some of you may remember back in 2011, Alabama suffered catastrophic tornado outbreaks. We lost over 300 people back on the end of April in 2011. The very first tornado of that morning was about a quarter of a mile from our office, and we were without internet service for 10 days. And so we learned the hard way that we needed to have a virtual office. So lucky for us, we actually had been practicing once a year, going virtual, how quickly we could get set up and making sure that everybody had an office inside their home. So when we decided to go virtual in all of our offices, I believe it was Friday, March the 10th, by Monday, by noon, we were fully functional. But the hardest part is that maybe it's all the gray hair that I have, is that I believe you do business with people, not with corporations, and it's hard to do business this way. It's okay if you've got a long-time relationship with someone, but trying to build new relationships over Zoom or Teams or some sort of video conference just isn't the same thing as being across the table from someone. A perfect example is a few years ago, we made a big investment in Switzerland. I learned about it on a Sunday. I was in the CEO's office Monday afternoon, spent 2 days with him negotiating a deal. And by the end of the second day, we had almost $1 billion transaction negotiated. It's really hard to do that this way. So the things that we're still struggling with is how long we're going to be doing this, how long I still can't get in Europe or in Australia or in South America, and how we're going to function in making new relationships like that over Zoom. That's the biggest change in our business. Some of the things that we've done from an acquisition standpoint, we made a big acquisition in January of this year in behavioral health. It's always been something that we've been very interested in, but the need for it has really come to light with everybody being at home in four walls by themselves with COVID over the last year. So I think that we'll probably have a bigger focus on behavioral health going forward than we've had in the past. Other than that, it's pretty much business as usual. We in the entire world probably were shut down from doing new business April through maybe August, but then everybody seemed to realize, okay, the world's not going to end. We are indeed going to move forward, and a lot of the transactions that we'd been working on prior seem to pick back up in August.
Yeah. Oh, and I presume everybody in your business is eagerly awaiting RTO, return to office. Let
me make one point that'll focus on what Owen does. Is we actually are not giving up on returning to work in the office space. We've got an office in New York. We've actually just expanded the office, doubled the space. It's been very important to us to have offices elsewhere other than just Birmingham and have people working from home. And so we plan to come back to work in a big way. Obviously, it's going to be very different, but we do indeed plan to come back and continue to operate in offices like New York.
Well, that is an excellent setup for Owen. I can see him smiling already. Owen, so I know you guys are preparing for that, but what changes did you all put in place during this that you expect to sort of live on in some way, shape, or form, even once the world starts fully getting back to the office?
Yeah, no, I'd love to address the whole work from home thing. Maybe we'll do that on the future question, but a bunch of changes. One thing I would just say is in terms of how we manage Boston properties, communication with the troops have been incredibly important when everybody's working remotely. We do a lot more town halls. We also are a regional company. We have employees in 6 different regions. And even though we're not in person, which is frustrating, in some ways it brings the regions closer together because you can more immediately, instead of having a conference for all the leasing people, around the country, you can jump on one of these calls more quickly and coordinate. So I think there's been some positives, that come out of this whole virtual Zoom environment, and it's helped us in some ways come together and coordinate more across all of our regions. So I think that's important. We've become much more, we have a lot more expertise on health security. We formed a task force. We hired outside medical experts. We have a detailed health security that we've shared with all owners. They care about this a lot more. On my flight a couple of days ago, the captain came out and gave us all a rundown of the air changes that were going on in our cabin during the flight. And I think this is the kind of thing we're going to experience in office buildings. I think our customers are going to be much more demanding of understanding things like air change, disinfecting policies, air filtration, all those things. And that's going to survive, I think, this whole COVID era.
Yeah.
We have done a lot of the demand in our space right now has been in life sciences. So we have, fortunately, a lot of the life science in the country is done in Boston and San Francisco, where we're the largest office landlord. So we just announced about a month ago 3 new life science projects that we're going to launch, which is about $500 to $600 million of new investment. And I think that's we've always been in that business. We're certainly emphasizing more, which is the one other thing we haven't all talked about is we had another crisis go on during COVID, which was the George Floyd murder and the demonstrations that occurred as a result of that. And we certainly responded to that at Boston Properties. We formed an internal diversity committee. We have, I'd say, elevated our efforts to promote diversity within our company. We've started initiatives to try to improve social justice in the communities where we operate. ESG, including the environmental piece, is also increasingly important to shareholders. We've increased our disclosures around all these topics, and that's, I think, a permanent change for the company. The other thing we hadn't talked about is we did raise a lot of capital in 2000, or I'd say over the last year. We right out of the gates, just to ensure that we were well capitalized, we did $1.25 billion unsecured bond deal. I think it was back in April of last year. And then given where rates and credit spreads were about a month ago, we did a $800 million green bond deal to refinance some more expensive capital in our capital structure. So again, that low rates has been also a good opportunity to be opportunistic and raise money and lower debt financing costs on our balance sheet.
Yeah, and we're going to talk more about that because this has been an interesting ride over the last year from a capital market standpoint. So we'll get to that in a minute. And you mentioned communication and the import of communication is always important, but the greater importance of communication in moments like this. Mary, you serve on a number of high quality boards. Maybe from a board perspective, your view on communication. You could also talk about investor communication, but just as a board member, is it just having a lot more meetings, or the meetings the same number of meetings, it's different type of meetings? But what did you find is the most value added aspects of things that were changed from a board narrative perspective vis-a-vis the pre-COVID?
Yeah, I'm fortunate. I sit on 4 public boards. I sit on a college board, and I sit on a private real estate company board. And that's how I spend pretty much all of my working time at this point. And, the reason they don't, that, that shareholders sometimes frown on people sitting on a lot of boards is because if one of your companies has a crisis, they're going to need to be available much more and how can you possibly be there for all the companies? So a good lesson of 2020 is that it is actually possible to have all of your companies be in crisis and still get through all of this. For me it was again fascinating window into leadership. And for me, from my investing hat in the past, remembering the financial crisis. And quite honestly, how well Boston Properties, how nimble they were then, and how solid public storage was. It's thinking about management and leadership, and listening to the CEOs of my companies talk about being able to look past this to the opportunity. Super interesting. Conversations are frustrating on Zoom. I think what Ed said is perfect. I mean, board conversations tend to die awkwardly on Zoom, and sometimes the person who talks the loudest isn't always the person that you need information from. I would say that part of it has been quite difficult. As a board member and as a socially responsible investor, I'd say that the silver lining of the very difficult time we've been through from a social perspective is this radical acceptance of the importance of corporate diversity, board diversity, and the importance of all the pillars of ESG. It's taken a lot of pressure from a lot of people for 6 or 7 years to finally get a reasonable number of women on boards, and to see that further expand, relatively quickly and pretty successfully so far, to incorporate diversity in general has been a real nice silver lining of this. All investors now are socially responsible investors. This ESG is not going away. And it's been great to see everybody pivoting towards that concept.
Yeah, it's very interesting, right? That this comes up over and over. We're so focused on the negatives, and there's a lot of them, right? Over the last year from a health perspective and everything everybody's been through. But, having mentioned now already, just the focus on diversity, on ESG, on social justice. I mean, everybody's zooming and everybody focused, and a lot more work to do, but with some great, focus and some strides made. And, sometimes we lose sight of that when we look backwards at what was a very challenging period of time. That's great. Let's talk about capital markets, because it was a unique experience every time. Like I look at, we've all been around the block a few times. I hate to say it, right? Everybody on this Zoom. So we've been through now a number of different crises. We've, grown into becoming the hopefully the wise old sages that we used to, sort of talk to and ask what it was like back in their day, right? But, whether it's 9/11 and the financial crisis and this, and there's a whole bunch of other mini bumps in the road that we've lived through, everyone is different. If they were the same, right? You just take out the crisis playbook, you'd open it up and you'd follow the directions and work your way through it. But you kind of have to navigate them specifically based upon what's thrown at you at the time. In this scenario, boy, due to the impact, the efforts and the focus by really governments around the world, the capital markets were reopened and functioning and liquid almost immediately. Right. And I think something else to be thankful for is, thank goodness that all worked out. Because if we had a financial crisis on top of a health crisis, you can imagine how much worse this all might have been. And not only did they open immediately and provide tremendous liquidity, but it was also given where interest rates are, low cost, right? Given where the benchmark, securities started. And unlike the financial crisis, the underlying securities in all of your public companies never spiked, right? You couldn't buy preferreds or converts or bonds at 10-12% yields like you did the last time around, and that was a good thing, other than maybe for folks looking to invest capital. Although really over the course of history, the other thing we learned is that doesn't happen too often. Usually when it's a human nature, when folks lose half their money their first gut move is not to bet the other half, right, but rather to harbor resources. But even the great private equity firms, for the first time that we've seen in many of these crises, were putting money to work in common equities, right, making a macro play where they thought it made sense because there wasn't a whole lot of ways to put money to work. But that was all born out of a very positive aspect of open and liquid markets, right? At not too crazy of a cost, and that's great. But now for the question, with all that as background, looking forward, right? You're talking about the long-term impacts of this. Does it change the way any of you look at your balance sheet? Meaning how you think about financing your business going forward versus the way you've historically financed it? Meaning even if it was conservative before, do you think it should be more conservative now? Or do you think that this is something that you were well prepared for and you kind of go back to the old way? I mean, do you think there's a long-term impact on balance sheets as a result of this? I guess is the question. In no particular order. Ron, if you want, we'll start with you, but others please chime in.
Sure. Well, we're a little different than most of the REITs. We use this thing called perpetual preferred stock. It's our total leverage is about, I don't know, $6.5 billion. $4 billion of it or so is perpetual preferred stock, which has this great feature called a 5-year call. So in 2020, we redeemed about $1 billion of preferred and issued about $1.3 billion of preferred. One which is at 3.88%, which is absolutely, I mean, I never thought I'd see below 5%, let alone below 4%. Okay. Because we've been doing this for 25 years. And so, we were able to lock in some really long-term, permanent capital at incredible rates. It really hasn't changed our view. When the crisis hit and demand dropped in Q2, of course, we were very happy that we had preferred, not a bunch of debt, and we were fairly liquid. That's the way we've pretty much operated for 15, 20 years, and I don't see that changing going forward. Preferred will always be part of our capital stack, and we tend to operate with a lower overall leverage than we need to. But we have a very high credit rating, and it reflects in the prices of the securities that we issue. Right, very good, very attractive coupons. So no change in the way we're going to finance going forward.
Mike, similar answer to us as well. We were in a great position when this hit. We had a tremendous amount of liquidity available to us, but probably more importantly is our operators did. Our operators were sitting on about $5 billion of liquidity. So their ability to pay rent, even in the darkest days of COVID, was never an issue for them or for us. Our stock performed exceptionally well in 2020. And as you know, we did an equity offering in January of this year, and it went very well. And then we just recently completed a refi of 2 bond issues. We did a sterling bond issue very recently at rates that I can only remember back when I was a little boy that I never thought we'd see again. So rates that are truly astounding. We think our leverage ratios are exactly where they should be. We think we've pretty much been there throughout the history of the company, and we're in a great position. So I don't see any significant changes to our balance sheet.
Owen, anything that you guys would change?
No, I don't think. I think it worked. We're Baa1 rated. It's the highest rating in our sector. Moody's just affirmed that rating. We did 2 bond deals, as I know, over the last year. The second one was our lowest coupon ever at 2.5%. Ron, actually, we had 300 million plus or minus of preferreds outstanding that were costing us over 5%, and we redeemed those with our debt offering. So I think it worked. On the equity side, our common has traded below NAV for years. We haven't accessed the common equity market for, I don't know how long, but it's definitely been more than eight years. And so we develop new buildings and create debt capacity, and that's how we create capital for new investment. And then we've increasingly been working with private equity partners in partnership for them to provide equity. We lease, manage, and co-invest. So I don't see us making a change. I think our strategy worked, through this crisis.
Yeah, it's interesting. The last couple of shocks to the system, right? The good old real estate environment the industry has performed pretty well, right? I think the days of massively leveraged companies, I think everybody's learned that lesson, and folks have navigated through these bumps in the road, I think pretty well. And maybe the next crisis will be different, but if history is a guide, it always feels like we're harboring balance sheet to play offense, when there's shocks to the system, and that rarely happens, again, because it's not usually the first move is defensive for obvious reasons. And secondly, if the world's kind of generally performing, and again, as it did this time around, there's not a lot of distress, right? And if there's not a lot of immediate distress, which is a good thing, for the industry, then there's not a lot of forced sellers. And so everybody just kind of, buys themselves runway and rides it out over the time. And there haven't been in the last few crises really, tremendous opportunities. Been some, but not tremendous ones to play offense. It's really more about playing defense. But, then again, there's a lot of preservation and shareholder value associated with playing defense. I guess, Mary, from your perspective, again, back in the day, as this industry has grown, and there's been, ongoing issuances of equity to fund that. There was always this balance in the past, and it just strikes me that it was more of a focus on not selling equity too cheaply, the dilution attached to it. And maybe even the day as an investor, you had conversations with folks saying, why did you raise that equity? It's, it's dilutive, and you could have funded things another way. And it was always a focus on that, as opposed to just issuing when the markets were open and when you were close enough, as opposed to trying to hit, those perfect windows. And I think over the recent past, that served people well. With all that as background, do you see, folks being more frequent issuers of equity, being less picky about, the timing of such and the pricing at which they do it? And would you be an advocate of that as both an investor and a board member?
Yeah, and I definitely do see that, and I think that the ATM is such a useful tool for companies to quickly access capital at moments when the market is inefficient, which was not something that happened even 10 years ago. You couldn't quickly do it, and so. I'm very mindful of making sure that every company has, every arrow in their quiver in terms of that. After the financial crisis, during the financial crisis, when we weren't sure REITs were going to be truly viable and every company raised equity just at a price, we still have many companies that are still growing out of those share issuances. So dramatic dilutive capital raising, that's a problem. But if, it's a privilege to be a public company, and access to capital is the essence of it. And if that's the way you have to go to save your company, you should do that. Also, another sort of riff on that is that right now, I think the market loves a strong balance sheet, as they should, for all the reasons we all discussed. But REITs are stocks, and people are making the decisions of buying REITs versus every other asset class, and investors want growth. And many investors view a balance sheet as not a strong balance sheet is not a strategy, right? A strong balance sheet is a means to a strategy. And so I think you should expect to see investors really looking at your capital allocation, really carefully going forward. What are you going to do with this great balance sheet?
Yeah, I mean, it does strike me that over the course of history, the extra dilution taken about by not, by issuing equity, maybe not at perfect levels, the cost of that, it seems well worth it vis-a-vis the cost of having to issue, right, or find yourself in financial trouble or having to issue at moments, when your stock's down 50%, right? I think most people have gained that focus, and so I do think you'll see a little bit more of that, over time. On the M&A side, maybe just sort of finishing up there, in the real estate side of the business, very jealous of our brethren in corporate America, as last year, second half of the year, we really saw the return of big M&A, and there was an awful lot of activity, across a number of spaces. in corporate America, but really almost, really there was a huge lag on the real estate side, right? For obvious reasons, just the longer term nature of the impact on some of the property types. Just put a real, the stuff that was set to close at the end of 2019 closed in the beginning of 2020, and then the pandemic started, and we really saw a lag in those sort of discussions, those strategic discussions. Starting to see some pickup now, and I guess the question is not so much about your own your companies, but just generally, either in your spaces or the industry in general. Do folks see that lag creating a pent up wave of M&A in the space? And if so, why? And if no, why not? I guess in Zoom, I should call on somebody. So let me start with you, and we'll go in reverse order.
Yeah, I think that, there are, I don't know the exact number. There are probably 15 or 20 office REITs. I don't see so much peer-to-peer, equity, mergers occurring. I think most companies have their strategies, buildings that they like. Again, there are multiple differences, so maybe there's some accretive deals that could be done, but I don't see a lot of that activity. I think in M&A and office, it's probably more, the question is more, are there going to be take privates? There have been, as I mentioned, most of the office companies are trading at big discounts to NAV, high look-through cap rates, particularly compared where you see some being done in the market. There have been some hedge fund and other investors that have come into some of the companies, proposed different slates of directors. And, I think that's more the question in the office world, is that going to happen as opposed to M&A between companies?
So I agree that there's not going to be much M&A activity from a peer-to-peer standpoint in our space, but there is going to continue to be a good amount of M&A activity in the hospital space, which obviously creates opportunities for us. We did about $1.5 billion of acquisitions in the fourth quarter of 2020. We've done $2 billion already in 21. A lot of that activity that just died when COVID hit is back. I think it would be a lot quicker if people were able to sit across the desk from each other. We would not have been able to do the $2 billion that we did in the first quarter of 21 this year had we not had a Luxembourg office that could travel freely throughout the EU. Same thing in Australia. Nobody can get in Australia, even if you're from Australia. So without having an office there, we would not have been able to do additional activity there. But I do think there's plenty of opportunity for us. It's just how quickly we and our customers can get it done, because we can't all be in the same room right now.
Okay. Well, maybe we just wrap up with everyone's thoughts. The topic is long-term. Where do you, this is a more general question, okay? Not necessarily associated with your businesses, but consumer behavior, customer behavior, investor behavior. What do folks see? How much of this is going to, what portion of it is going to change? How soon before will we get, is it a full return back to sort of pre-COVID thinking amongst all those folks? Everybody's individual expectations in terms of the ramp back up and how much of this lingers.
It was interesting before we started the session. I was listening to Mary and Owen talk about the differences. Mary's down in Florida right now, and the differences of her home and how people are acting in Florida. I've primarily spent the better part of COVID in two places, in Alabama and Utah. And I can assure you that all of the people in Alabama and Utah think that COVID is over, and they are back to normal. They are back to where they were pre-COVID. That is clearly not the case everywhere. And I was speaking to one of our clients in Germany last week, and he was shocked. He was absolutely shocked, because it's very different in Europe than it is in places like Utah and Alabama. I do think that we'll get a lot more closer to normal than I would have thought in maybe last fall. It's interesting to track some of the credit card spending and see the amount of people that are flying and people that are getting to go to different places. it is reassuring, Mary. I think you talking about when you, or maybe it was you, Owen, who got the vaccination, and when you can actually go out to eat for the very first time, it's like being a little kid at Christmas time. It's truly amazing. So I think there's a lot of pent up demand. We are a society, human beings. We're not meant to stay inside these four walls and not see each other. So I think that when people do start feeling comfortable, it'll come back with a vengeance. Now, there are obviously some places that'll be much slower, but I think we get very closer to normal than I would have thought last fall.
So I'll just chime in here shortly. So, our business has been evolving onto one of these things, the phone, and I think that just continues. The customer's already there, right? All of us do so much business on the iPhone, and our business lends itself to that because it's a relatively modest month-to-month expenditure in and out. And so I see that continuing in our business, which will impact obviously how much we invest in technology, what it has in terms of an impact on property labor. In terms of the work from home corporate office, I have a hard time seeing it go back to the way it was. Maybe there's a couple days a week where you go in for a group meeting, but I especially when you're in the large centers like LA or San Francisco or New York, do I really need to commute an hour and a half each way to go to work for a 5-hour meeting? So I think the work from home is here to stay. Maybe not as extreme as it has been in terms of all the Zoom calls, but I don't think it's going back to the way it was. Having said that, because I'm here in LA this month, I can tell you traffic is pretty much back to the way it was. Freeways are nice and clogged, and peak COVID, you could get to the west side of LA in 30 minutes, and now it's back to an hour and a half to 2 hours. So.
Mary or Owen, any last thoughts?
Yeah, I think look, the thing that's different for office is usually when you have a recession, your customers also go through a recession. Their businesses don't do well. They lay off people. They need less space. That's not what happened during COVID. A lot of our customers actually did incredibly well. Their revenues are up. They've employed new people, and they haven't taken office space for it. So the question for office is not what the health of the customer base generally. It's how are people going to use the office, and what impact will that have on space demand? And I think the employers have in-person work. They need the collaboration, the onboarding. They feel they have a stronger company the more their people are collaborating. And I think employees also want to come back to the office, but they also want a work from home benefit. They want more flexibility. They want a hybrid model. And then I think for office, for the ownership of office and the performance of office, it'll be all about how do companies manage that hybrid model, and can they really save space? Can you schedule people out of the office? Can you hot desk people that are accustomed to a fixed workstation? Those will be the kinds of questions that'll be out there.
Yeah, I think it's what we see right now is, I agree, people are desperate to get back to some kind of normal. Desperate is the right word. They're desperate to travel. They're desperate to go on vacation. They're desperate to go back to the office, or they're desperate to never go back to the office. But just the fact that you can work from home in addition to working at the office, that's a change that we have to figure out, right? To me, what I've been thinking about over the past couple of days is really just kind of like the ripple effect, or maybe the exponential effect of societal behavior and what it's meant for fundamentals. Online shopping exploded in 2020, but it's still not the biggest part of retail, and we all knew that was coming, and it destroyed pricing power for the malls. It destroyed it. And what does that mean for other sectors? If business travel is just going to be 10% less than it used to, what does that really mean for travel? If people go to, if 80% of the people are in the office every day, what does that mean for office? And so that's something that this is something that I'm never going to forget. And I'm just barely starting to understand what it's going to mean for the stocks.
Yeah, I think we all agree. There is a newfound appreciation among almost every human being for the normal things, right? Things that we kind of took for granted. And I agree with everybody. Ed, you said it right. I mean, it's just, I think, going to be a tremendous pent up demand here. And I think the spring back will be a lot quicker and stronger than most people expected, at least 6 months ago. There will, I think, by definition, if history is a guide, there will be some non-cyclical, meaning secular things that we will live with as a result of this, and we will adapt, and they'll just become part of our lives. But I think the vast majority of it is going to sort of pop back quickly. But we'll see. I want to thank you all for your time. Really enjoyed the discussion, and I think we are all in agreement as well that we wish and we hope and assume that we will be back together in person as opposed to on boxes next year as part of this. But thanks everybody for your time. Appreciate it.
Thank you.